President Obama has been talking consistently about economic growth. The way out of our fiscal problems is to help the American economy grow. And here at the San Marino Business Partners, we think that all of you ought to understand where economic growth comes from. Because it's economic growth that's ultimately going to be the source of return on your investments. And in thinking about this, there's one very important thing to keep in mind. Long-term, consistent economic growth should be distinguished between short-term fluctuations. The crash of 2008 was a bad event, but it was a short-term fluctuation. If we're talking about where this country is going in 5, 10, or even 20 years, we need to understand where economic growth comes from. And the answer there is quite surprising. So let's take a look at it.
Let's start with the basic definition of real GDP. Where does GDP come from? Well, there's a pretty simple equation for that. It equals the number of people working times the average worker productivity. So if we're going to talk about a growing economy, there's only two ways that in the long run the economy can grow. Either the population grows, and along with it the number of people working, or worker productivity grows. Now, a growing population will increase real GDP, even if productivity doesn't change. But it won't make people better off, because the increase in real GDP will be exactly offset by the growth in population. So per capita real GDP, which is what really determines the standard of living, doesn't change. If you want the standard of living to improve, then worker productivity has to improve. And that is the key to economic growth. So the most fundamental question that we all have to ask if we want to have a better and wealthier society, what are the sources of productivity growth? And in the long run, there are really only three. First, we can provide more physical capital per worker. But there's a limit to how long that's going to allow for increasing productivity. If you give a secretary one typewriter, he or she becomes quite a bit more productive. If you give them a second typewriter, it sits on a shelf. So in economic terms, there are diminishing returns to adding more physical capital. The second thing you can do is to increase human capital. The people can be better trained and more highly educated, but even that faces diminishing returns. The third possibility is there can be technological innovation. Instead of handing that secretary a typewriter, you can give them a word processor and then ultimately a personal computer. And it is this technological innovation that has been the primary source of economic growth on a per capita basis for the last 200 years. Indeed, for most of human history, when there was very little technological innovation from the dawn of humanity up until about the birth of Christ, there simply was no economic growth. So this underlines the importance of innovation in providing growth and in eventually thereby making possible positive returns on stock market type investments.